Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this course, we will be discussing fundamental analysis and decision making. As always, there is, of course, inherent risk when trading the financial markets. So just before we begin, please do take a moment to familiarize yourself with the following disclaimer. In focusing our attention during this webinar to fundamental analysis, what we aim to outline is the foundation of fundamental analysis. Why is it different than technical analysis? And why is it such a prominent school of thought in terms of financial trading? With that, we will be looking at quantitative versus qualitative data. We will be assessing true market drivers and those market drivers specifically that affect price over the long term. That leads us nicely on to assessing economic data as well as those large non-economic events that totally change the macroeconomic or can totally change the macroeconomic environment that the market is experiencing. And that obviously leads us nicely into looking at market positioning. How do the large financial institutions actually position themselves in the market looking for long-term price profit? First and foremost, let's look at the foundation of fundamental analysis. Global asset prices move as a direct result from what is happening in the larger economy. Depending on the asset class or market, the fundamental trader must acquire a unique level of knowledge specific to the market to be able to develop an edge, a trading edge, and obviously then trade effectively. The characteristics of fundamental trading can also be very different depending on the asset class. Forex trading requires a wealth of knowledge on macroeconomics. Commodity trading requires complex reasoning of the supply and demand variables of that commodity. And equity traders must have the know-how to fundamentally analyze price-earnings ratios, growth projections, and company performance in relation to competition. So really, no matter the scenario, knowledge is power. In better understanding the overall economy, then, we can achieve a better awareness of how asset prices will move with economic data. So let's actually consider a few of those economic data examples. We have sustained economic growth. How does that affect equity prices? Well, of course, we'll see equity prices rise over the long term. As the macroeconomy is performing well, we will see more jobs come into the economy, job creation. We'll see more consumer spending, and we'll see that result into strengthening equity prices over the medium to long term. Rising inflation. Perhaps what effect would rising inflation have on the gold market? Well, the hedge against inflation is one of the traditional motives behind gold investment, and really is to protect capital erosion against the rising costs of goods and services. The investment community often floods the precious metal market in search for a store of value. So if we just think about that for a moment, we know gold is a store of value. We know that rising inflation relates to long-term increases in the price of goods and services. So if we want to protect our capital from that price increase of currency or goods and services, what we'll look to do is actually invest in something that can store that value, and hence gold. So we'll see prices rise in gold. Rising oil prices. How might this affect perhaps a currency? Let's look at this example, the US Canadian dollar. Well, when prices for a key export increase, domestic currency of economic exporters will also increase. Now, the Canadian dollar, otherwise known as the loonie, is quite significant in terms of oil prices. The loonie will strengthen when oil prices rise, as oil is a major export product for Canada. So we will generally see strengthening oil prices and a relative strengthening in the Canadian dollar, or otherwise, as expressed in this small chart, downside in the US dollar, but that's really representative of strength in the Canadian dollar. Escalating conflict in the Middle East and oil. Well, this is much more of a simple one. Obviously, we'll see prices go up as there are fears that the supply mechanism for oil from the Middle East may be compromised. We'll see oil prices rise. As we move on discussing fundamental analysis, of course, and as its foundation, we cannot forget legendary investor Warren Buffett, who is a key investor in assets like Coca-Cola. He owns his own investing firm, Berkshire Hathaway. And really, his idea stems through global investment communities, and his knowledge is absolutely fantastic indeed. The aim of the fundamental trader is to assess value. So he's a real value trader. If we properly assess value, then surely we can develop our decision-making skills to identify promising trading opportunities. And that's it. That's really the asset of a good fundamental trader, to properly assess that value as a result of the fundamental research. So a good quote from a legendary investor Warren Buffett is, "It's far better to buy a wonderful company at fair price than a fair company at wonderful price." And that's absolutely the case. As we assess fundamental analysis and decision making, we must look at quantitative versus qualitative data. Now, considering the distinction between the two types of data, we typically define them by referring to data as quantitative if it is numerical in form, and qualitative when the data has a more theoretical basis. Now, why is that the case? Well, qualitative data is more concerned with understanding human behavior from the informant's perspective, and the informant is simply ourselves as economic agents and traders. It assumes a dynamic and negotiated reality, so there's a level of discretion to understanding our qualitative approach. In contrast, quantitative data is concerned with discovering facts about social phenomena. It assumes a fixed and measurable reality. In other words, the fixed and measurable reality is the raw data, the numbers that we try to derive social phenomena and extract thought from that. With the method, dat data are collected through participation observation in interviews. Data are analyzed by themes from descriptions by informants, again, that's simply us, and reported in the language of the informant. In contrast there, quantitative data are collected through measuring things. Data are analyzed through numerical comparisons and statistical inferences, and data are reported through that statistical analysis. So we use with quantitative data the raw data to formulate charts and graphs to give us an overall picture statistically, to look for social phenomena and obviously help trading decisions. Fundamental trading is considered to be more a qualitative approach. Qualitative research is multi-method in focus, involving an interpretive, naturalistic approach to its subject matter. This means that qualitative researchers study things in their natural settings, attempting to make sense of or interpret phenomena in terms of the meanings people bring to them. Research following a qualitative approach is exploratory, and it seeks to explain how and why a particular market is behaving. And therefore, fundamental traders often base their trade decisions on a question of value. Now, what does that mean for our trade decisions? Well, if research shows that an asset is undervalued, these traders will look for buying opportunities. If, on the other hand, research suggests an asset is overvalued, these traders will look for selling opportunities. Technical trading, on the other hand, is considered to be more a quantitative approach. Quantitative research collects data in numerical form, which is then subjected to statistical analysis. The data is then measured to construct graphs and charts to physically represent patterns or ideas that provide statistical reasoning. As the research is used to test a theory, it aims to ultimately support or reject the hypothesis. So as this approach tests raw data, it can be applied to many different environments, and that's a huge advantage to using this quantitative approach, and actually deriving reasoning from the raw data across many different fields or industries. Data analysis helps us turn statistical data into useful information to help with decision making, and therefore quantitative research is more focused on objectivity. And that would certainly be the main reason why we would say quantitative approach or quantitative trading. It has more of an essence of technical trading, because as technical traders, we want to become very objective. If we look towards our technical indicators, to take Bollinger Bands as an example, it uses a statistical model across a variation from the mean and follows price action to look for objective trading decisions as such. So certainly the case technical trading is considered to be much more of a quantitative approach. Let's look at true market drivers and assess how those market drivers really affect price over the long term. Market trends are shaped by larger economic factors. So first and foremost, we can look at government influence. How can a government influence the financial markets and really drive prices over the long term? By increasing or decreasing interest rates, the government or the US Federal Reserve in the US there can slow or accelerate growth. So this is called monetary policy. So actually by using government policy, they can manipulate the financial markets. They can actually manipulate the price of assets and actually fundamental themes including rates of unemployment, consumer spending, and actually try and slow or if the objective is to accelerate growth, they can do that via monetary policy. The government can attempt to ease unemployment and stabilize prices by increasing or contracting spending. This is called fiscal policy. So very real events, social events or social constructs within an economy can be changed and manipulated by government influence, and that can lead to long-term price drives, particularly in the equity indices and in something like a domestic currency. Capital flow. Now, why would capital flow have a huge impact on market price and really drive prices over the long term? The more money that leaves a country, the weaker the country's economy and currency becomes. Countries that export more than they import keep their economies generally quite strong. And we can see the level of capital flow between nations. We have certain agreements, NAFTA to be one there. It's seen a little bit of hype and discussion in the news at the moment. Certainly these trade agreements and levels of capital flow as they move from country through country affect exports and imports and have an overall economic effect on the domestic economies. Speculation and expectation. The direction consumers, investors, and politicians believe the economy is headed impacts how we act today, and that is most certainly the case. Sentiment indicators gauge what certain groups think the economy is doing. So this is one example where we can see actual speculation and expectation almost become a self-fulfilling prophecy, whether it's the financial institution or investor or a top-level politician that believes that prices aren't stabilizing and there needs to be some real government change. That can actually cause a self-fulfilling prophecy when the government comes together to actually interact change and actually confirm policy change towards long-term price movement. And there's our level of consumers there. Supply and demand. And obviously the key function of supply and demand will totally dominate many assets, particularly the commodity markets. Supply and demand for products, currencies, and other investments. Items in demand with shrinking supplies will see their prices rise. If supply outpaces demand, prices will fall. And it's always a balancing act between supply and demand to actually interact with the market forces, to drive the market, and to formulate what the market sees as fair value at that given time. As mentioned there, particularly in asset classes such as commodities, the oil market, soft commodities like wheat, sugar, they are all very much supply and demand driven in terms of their price. And that's certainly a true market driver over the short, medium, and long term for those asset classes. Economic data. Economic data is important as it reveals a true picture of an economy's condition. It allows traders to understand how an economy stands in respect to others and can help us determine whether monetary and fiscal policy and other financial programs have been successful. So, why is it so important in terms of decision making and fundamental analysis to understand economic data? Well, because we need to understand the overall macroeconomic picture of a domestic economy and how those economic data releases are actually subjected to discretion are subjected to a level of interpretation by market participants. In keeping with that, we look at the business cycle. Economic data is particularly important to us as it can indicate how the economy is performing at those various stages of the business cycle. So most certainly, what would be more significant is a huge jump in the rate of unemployment, for example, a huge decrease, sorry, in the rate of unemployment would be more significant in times of recession as opposed to a time of boom where unemployment is very high. So that will certainly drive the market in very, very different scenarios, where you will see economic data surface in the market, and upon that announcement, prices will move according to how the market interprets the data at the given time throughout the business cycle. Now, when trading on economic data, we must ensure that we know exactly what we are doing. In order to trade on this economic data, we must understand how the released data will fundamentally affect the market in question. The data very much depends on the market we are interested in trading. And that's very, very important to notice. I'll give you a very simple example. If we are looking to trade the crude oil inventories, we will certainly be looking to trade the oil market as opposed to a Forex pair based on a huge increase or decrease in supply in those crude oil inventories. So it is indicative of which asset class or market that we're choosing to trade. Economic data often has a very different effect in the short term than in the long term. So do be aware of that when trading the financial markets, guys. Often what you can see is a short term burst to one side. The market can react quite irrationally. We often see a quick burst perhaps to the downside in price movement. And as market participants come together to formulate and reason behind fundamentally why the market is pricing in the news that way, we can see prices reversed in the more medium to long term and actually, in this case, create new highs and form a bullish trend. So markets can react irrationally to economic data and often misjudge or misprice. Market fundamentals often take time to affect price change and create trends. Let's have a look at non-economic events. They can be quite significant in terms of fundamental trading and their effect on the markets. Fundamental trading lends itself to also interpreting how non-economic events can affect price. Analysis must often be carried out individually for each particular asset. What non-economic events affect price and decision making? Well, perhaps internal developments within a company. So if we look at a stock or perhaps a stock market equity like Google, very famous indeed, perhaps there's a very concerning internal development, considering profit projections that have not been released to the market, but when the market gets wind of this projection, these developments cause very, very sure and sudden price movement for the particular market in question. We look at world events, again, a non-economic event, but certainly global world events such as war, civil unrest, and natural disaster. Often we see in the United States, hurricane season can have a devastating effect on some of those financial assets as well. And hype, of course, is one not to be misgiven. Hype is very, very important in terms of sentimental analysis. And if we look across what has happened there over the last 6 months, certainly considering Bitcoin and the frantic price rise of Bitcoin, we can see that hype had very much a big factor, a big role to play in price movement in the cryptocurrency. Let's look at a case study here for a non-economic event. We have Enron. If you're familiar with this case, it's an absolutely fascinating story. Enron, 2001, a company, it was an energy corporation in America and a commodities company, once self-proclaiming to be the largest energy company in the world. Enron eventually filed for bankruptcy following a sustained institutionalized accounting fraud that inflated share prices for several years. Absolutely scandalous. The aftermath of the Enron scandal destroyed confidence in corporate America and led to a huge retreat of capital from US equities, particularly, it may be mentioned, in the energy sector. So obviously, as an energy company, This destructive news can filter its way in through the sectors and obviously cause very, very negative long-term price action indeed. Although the scandal was a huge shock to the market, fundamental traders knew this non-economic event would have hugely negative effects for months to come. We have a quote here from Robert Mueller, who is heavily involved in the case. The collapse of Enron was devastating to tens of thousands of people and shook the public's confidence in corporate America. Can you think, obviously, why a case like this could really have such an effect on equity investment in America, particularly in perhaps an energy sector or utility sector investments? Such a huge scandal. Obviously, it's trading equities has as much to do with confidence in ownership of shares as well as price performance. So it had a devastating effect, and just goes to show how a non-economic, singularized natural event like this within one particular company can have such a negative effect in the marketplace. That leads us on nicely to market positioning. Market positioning is all about the big players, the big traders in the marketplace that are looking for these big trades. They don't necessarily involve themselves with short-term scalping or very short positions in the marketplace like many traders do. What they look to do is, particularly hedge funds, develop a very consistent, very well thought out fundamental trade decisions based on a lot of acute fundamental analysis and decision making. For many large market participants, such as financial institutions and hedge funds, the very essence of their trading will target long term price changes as a result of changing macroeconomic variables. Their decisions are thus a result of very carefully conducted fundamental analysis. So this can help us as well if we know a large institutional is positioning itself within the marketplace. If we have a feeling or a sense or perhaps news that would dictate with which direction they're looking to trade, that will certainly aid us in our decision as well. In the prelude to large news events, such institutions will build large, long, or short positions in the marketplace. The objective is either for protection from risk or from profit. Obviously, profit being a main objective for long term fundamental price change. Why would they look to perhaps protect themselves from risk? Well, if they perhaps know that there's going to be a large appreciation or depreciation in the currency, they may have a lot of other assets denominated in that currency, and the objective, therefore, could be to position in the market to actually look to hedge that risk within the currency markets themselves. So, with many different objectives there, they look to take these huge positions in the market. It is often these large market participants that cause large swings in volatility when realities do not meet the market expectations. And that's absolutely the case. What we'll do is actually look at a few examples here to explain what we mean when we see market positioning go wrong. Here we have the Brexit vote, and this is the cable or pound US dollar market. Obviously, very significant in terms of a world non economic event, but it was a huge piece of news and a huge shock to the market at the time. And obviously, we can see how the currency itself reacted. What we see is fear within this price charting moving down. We see a little bit of a price channel form with a support level of resistance. However, that fear leading up to fear and uncertainty leading up to the weeks just before. These are daily candlesticks. The week before the actual decision shows that there is some fear and uncertainty and some money coming out of sterling in relation to the dollar. What we then see is market positioning. I do remember 1 week before we seen a lot of fundamental analysts coming out with their forecasts to say it was more or less a done and dusted deal, that there was no way the UK would be leaving the European Union. And we see this reflected in the market price. Market positioning then hits the bottom with many green candlesticks in a row, suggesting that this is being priced in. These large market participants are really pricing in a stay vote that the UK will most certainly stay within the European Union. And that's reflected as the price trades up within this week, leading up to the decision itself. Then what we see is the Brexit leave vote, a massive shock to the market. We see some serious volatility to the upside and downside, and then the currency actually trades down the whole way from around 147 to 133 within 1 day trading, an absolutely huge percentage loss in the overall price of sterling. A huge shock to the market. We can see that it's technically very significant given how market positions were actually gearing up for a stay vote. They were all proved wrong, and that's inevitably, if we look closer at this price action, what we see within the price action. The candlestick structure here tells us a fascinating story of how market participants began to prematurely price in the expectation of a Brexit stay vote. Heavy long positioning accumulated in the pound US dollar almost a week before the fundamental decision was made. So they're trying to position, they see a very strong probability that the UK will obviously vote to stay and sterling value will increase over the medium to long term. Certainly that does not happen. They are proved wrong and they suffer the consequences. So a fantastic example to see how market positioning, particularly with expectation versus result, actually affects the market. Again, market positioning, we look at the US presidential election. This is the S&P 500. What we can see here is uncertainty leading up to the November presidential election decision. In the week leading up to the presidential decision, market participants prepare for uncertainty by unwinding long equity positions. So there's just that added level of uncertainty in the markets. In terms of a risk on, risk off approach, which we'll be discussing with many of the fundamental analysis webinars, we can see money coming out of US equities and really positions unwinding as the market trades down to new lows there. Then what we see within this little green area in the days preceding the election, market participants begin to position for an expected Democratic win. Almost like the Brexit vote, it was starting to be priced in that Hillary Clinton was ahead in the polls. There was no way Donald Trump would be elected by the US populace, and that the market really starts to position for the higher probability trades. Evidently, what we see there in the market experiences large volatility. We can see the candlestick there just, I think it's the 9th of November, that date indeed. We can see the Trump win causes severe volatility to the US equity market. But what it does actually is eventually lead to a bullish trend as the market formulates where prices will go, what that actually means, Trump's election, what it means for the overall economy. Obviously, he has huge reforms and has implemented his reforms in terms of tax and what that means in terms of US speculation on equity prices. And we see a large trend start to path the way from that day indeed. And that concludes our study of fundamental analysis and decision making with our webinar outline there. We should at this stage understand the foundation of fundamental analysis, why it is so key in terms of fundamentally analyzing the financial markets and deriving a basis of price value. We should understand quantitative versus qualitative data and the difference really that quantitative is more numerically focused and qualitative is a human behavioral approach to assessing data. We looked at true market drivers and particularly assessed things like government influence, supply and demand functions, and how they can affect price. We looked at economic data and non-economic events and see how those news events really play out in the market in terms of being objectively discussed through market participants and how those market participants react in accordance to their sentiment on those data forms. Then we looked at market positioning and we can see how those large financial institutions really gear up for the big term trades, the macroeconomic trades, and when they are wrong, how price can be very volatile and cause massive shocks to the markets indeed. Thank you very much for joining us on this latest installment of Courses on Demand by Forex Academy. We do hope to see you very soon. Bye for now.